Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 116, and in this episode we are reviewing the performance of the global markets during the 28th week of 2024, and that is from Monday the 8th to Friday the 12th of July. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where for the first time in more than 4 years, the monthly inflation rate dipped in the month of June, providing further evidence that the Federal Reserve will start cutting interest rates later this year. According to the report released on Thursday by the Bureau of Labor Statistics, the Consumer Price Index, which is a broad measure of prices for a select basket of goods and services, this declined by 0.1% from the previous month of May, whilst the 12-month rate fell from 3.3% in May to 3% flat in the month of June. And excluding volatile food and energy prices, the core inflation rate increased by 0.1% on a monthly basis and by 3.3% on an annual basis. And staying in the United States, on Tuesday, the Federal Reserve Chairman Jerome Powell expressed concern that holding interest rates too high for too long could jeopardize economic growth. During a two-day appearance on Capitol Hill, the Fed chairman said that both the economy and the labor market remain strong as inflation continues to ease off, and with policymakers committed to bringing inflation down to its 2% target rate. The Fed's overnight borrowing rate currently sits in a range of between 5.25% to 5.5%, which is the highest policy rate over the past 23 years, and this was in response to persistent inflation that also hit its highest levels since the early 1980s. And moving across to the United Kingdom, flash figures published on Thursday by the Office for National Statistics showed that the UK economy grew by 0.4% in the month of May, which was way above the market forecast for a monthly expansion of just 0.2%. The British economy experienced a shallow recession in the fourth quarter of 2023, but managed to bounce back to marginal growth in the first quarter of this year before flattening out in the month of April. In response to these data, the sterling pound jumped to a 4-month high against the US dollar and was trading at around 1.2863 versus the greenback. And from the People's Republic of China, customs data released on Friday showed that China's imports fell in the month of June, while the value of exports rose more than expected. In US dollar terms, the value of China's imports declined by 2.3% in the 12 months to June 2024, which was in sharp contrast to a growth forecast of 2.8%. On the other hand, the dollar value of China's exports increased by 8.6% in the 12 months to June 2024, and in the process beat market expectations for a growth of 8%. In summary, on a year-to-date basis, China's imports have increased by 2%, whilst exports are up by 3.6%, and that is in comparison to the same period last year. Staying in China, data from the National Bureau of Statistics showed that domestic demand has remained subdued as China's consumer price inflation over the past 12 months rose by 0.2% in the month of June, but fell short of market expectations for an increase of 0.4%. Similarly, the Producer Price Index, which measures factory gate prices, dropped by 0.8% over the past 12 months. Meanwhile, the core consumer price inflation, which strips out volatile food and energy prices, this rose by 0.6% in the 12 months to June and was slightly lower than the forecast rate of 0.7%. And back in the United States, on Friday, the Dow Jones Industrial Average soared to an all-time high as it broke above the 40,000 level, driven up by bellwether stocks such as Home Depot and Caterpillar. As the Consumer Price Index declined to 0.1% in June, investors piled into the Dow stocks on the hope that slowing inflation would be followed by a Federal Reserve rate cut in the month of September. Earlier in the session, the 30 stock blue chip index hit a new all-time high of 40,257 before profit taking, so it corrected down to 40,000 flat, where it closed the session with a gain of about 247 points. Meanwhile, the S&P 500 ticked higher by 0.5% to close at 5,615, whilst the Nasdaq Composite was up by 0.6% to end the day at 18,398. In the US bond market on Thursday, Treasury yields tumbled, with the 10-year Treasury yield falling more than 7 basis points, whilst the yield on the 2-year Treasury note dropped by more than 11 basis points. This came after the Consumer Price Index declined to 3% flat in the month of June. On Friday, the yield on the benchmark 10-year Treasury bond was marginally lower as it dipped by 1 basis point to close the week at 4.18%, whilst the yield on the policy-sensitive 2-year Treasury note fell by 5.1 basis points to close the session at 4.45%. Following the release of the inflation data, traders are now pricing in a more than 90% chance that the Fed will begin easing monetary policy as soon as September. For your information, bond yields and prices have an inverted relationship, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil fell on Friday and in the process snapped a 4-win winning streak as the recent rally appears to have lost its momentum. Despite the dip, crude oil prices are expected to bounce back in the near term as demand picks up during the US summer season. Crude oil prices have also been bolstered by the prospect that the Federal Reserve will begin cutting interest rates later this year, and this in turn is expected to stimulate demand for fuel oil. For the week, the U.S. benchmark West Texas Intermediate crude posted a loss of 1.14% to trade at $82.21 per barrel, but on a year-to-date basis has gained about 14.7%. In the meantime, the global benchmark Brent crude fell by about 1.74% during the week and came to a close at $85.03 per barrel, but on a year-to-date basis remains positive by about 10.4%. In the precious metals market, following the unexpected decline in U.S. inflation, the price of gold held above the key psychological level of $2,400 per ounce. Bullion was headed for its third consecutive week of gains as investors grew more confident that the Federal Reserve will begin cutting interest rates in the month of September. According to the CME FedWatch tool, markets are now pricing in a 96% chance for a September rate cut. The prospect of lower interest rates is expected to boost the price of gold as it reduces the opportunity cost of holding this non-yielding asset. For the week, the price of spot gold was up nearly 1% and was last seen hovering around $2,411 per ounce. In the cryptocurrency market, one of the major concerns about investing in cryptocurrencies is the fear of losing your crypto to hackers. This is a legitimate concern and was confirmed by TRM Labs, who last week published a report showing the amount of crypto that has been stolen in the first 6 months of 2024. According to the report, about $1.38 billion worth of crypto was stolen in the first 6 months of 2024. And to add fuel to the fire, this amount was more than double the $657 million that was stolen in the first 6 months of 2023. According to TRM Labs, the top hacks in 2024 revolve around the compromise of private keys and seed phrases, which are a sequence of random words that store the information that is required to access or recover a crypto wallet. And just for your information, the largest crypto hack so far this year swiped more than $300 million worth of Bitcoin from DMM Bitcoin, which is a Japanese crypto exchange. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the shilling was broadly flat against the major international currencies. And according to data obtained from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 128.98, and this is compared to 128.71 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 131 to 132 shillings. The lowest rate was offered by Stanbic Bank at 131.55, whilst the highest rate was quoted by I&M Bank at 132.30. Meanwhile, the sterling pound was priced at 165.50 and the euro was valued at 139.60. And on the regional front, one Kenyan shilling was changing hands for 28.72 Ugandan shillings and 20.58 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.15. The shilling now appears to be relatively stable against the US dollar. However, this may just be a short-term consolidation following the successful issuance of the latest Eurobond, which helped the country avoid a potential sovereign default. The fact of the matter is that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we now all know, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $121 million to $7.89 billion, which is equivalent to 4.1 months of import cover. This level of reserves is compliant with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. However, despite this short-term compliance, Kenya's foreign exchange reserves remain under intense pressure, partly due to the persistent current account deficit, where imports perpetually exceed exports, and this is further exacerbated by our ever-increasing national debt, which has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was well funded through open market operations as the interbank rate dipped by 9 basis points from 13.26% the previous week to 13.17%. On the back of that, the average value that was traded in the interbank market increased to 29.6 billion shillings, and this was up from 24.2 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement stood at 18.4 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total deposits which commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 11th of July, and the central bank received bids totaling 32.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 137%. The central bank ended up accepting 30.2 billion shillings, and the results of the auction were as follows. The 91-day rate ticked up by about 1 basis point to 15.99%, whilst the 182-day rate increased by 2.6 basis points to average out at 16.82%, and the 364-day rate registered a gain of about 5 basis points to settle at 16.87%. In the secondary bond market, the turnover in the domestic market declined by about 25% during the past week. And in the international markets, during the past week, the yields on Kenya's Eurobonds were on a downward trajectory, with the yield on the 7-year 2024 Eurobond decreasing the most by 40 basis points, as it dropped from 10.9% recorded the previous week to 10.5%. At the Nairobi Securities Exchange, during the past week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 2.2%, whilst the NSE 10 and the NSE 25 both gained by 1.9%, and the NASI gained by 0.9%. This takes the year-to-date performance to gains of 24.6% for the NSE 10, 21.9% for the NSE 25, 19.6% for the NASI, and 12.4% for the NSE 20. The market's performance was driven by gains recorded by large cap stocks such as Bamburi Cement, which increased by a whopping 37.9%, whilst KCB Group and East African Breweries recorded moderate gains of 6.7% and 4.7% respectively. This performance was, however, weighed down by losses recorded by other large cap stocks such as Safaricom and Absa Bank, which declined by 1.4% and 1.1% respectively. And in related news, and the reason why Bamburi shares increased sharply, that was because Amson's Industries Kenya Limited, which is a subsidiary of Amson's Group from Tanzania, announced its intention to acquire 100% shareholding of Bamburi Cement. Amson's Industry has made an offer of 23.6 billion shillings, which translates into a purchase price of 65 shillings per share, and that works out to a 42% premium based on the closing price of 46 shillings per share that was recorded on the 9th of June. If this acquisition is successful, Bamburi will become a private company and will therefore have to be delisted from the Nairobi Securities Exchange. Up next is our topical issue, and this week we're looking at Moody's downgrade of Kenya's credit rating. On Tuesday, the global rating agency Moody's downgraded Kenya's credit rating and cited the country's inability to implement austerity measures due to the withdrawal of the unpopular 2024 finance bill. Kenya's credit rating, which was already in junk status, was further downgraded from B3 to Caa1. And just for your information, the junk rating means that Kenya's debt remains highly speculative and there is a high chance that the country will default on its debt if there is a shock to the economy. The downgrade means that Kenya's debt obligations are now considered to be of poor standing and are subject to a very high credit risk. Kenya now has the same credit rating as Ghana, which was downgraded by Moody's in June, and that was after it defaulted on its debt obligations in December 2022. According to Moody's assessment, Kenya's downgrade is a result of its diminished capacity to implement revenue-based fiscal consolidation, which would help to gradually reduce its debt obligations. Moody's also raised concerns about Kenya's ability to implement austerity measures that would entail cutting expenditure. The reason for this being that a huge chunk of Kenya's expenditure is reserved for debt repayments, which are non-discretionary expenses and must be paid to avoid falling into default. The credit rating agency further noted that whilst there was still some room to cut development expenditure, it was not advisable to do so as any further cuts would curtail economic growth. In summary, Moody's decided to maintain Kenya's credit outlook as negative, which means that it is likely to further downgrade this rating if the country fails to implement measures that are aimed at avoiding a potential sovereign default. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is now available on all the major hosting directories. That is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri is spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, the best preparation for tomorrow is doing your best today. A quote by Jackson Brown Jr. Think about it. Thank you, and God bless.